if you think you're going to quit, it's not going to be just by buying multifamilies. Not today, not with interest rates where they are, prices where they are. There's been very few times where you could come at it and, quit in 3 years or something off of the cash flow. These moments in time, like 2019, the COVID stimulus in 2020, 21, like these moments in time where you can, like I did, double a couple and just get lucky on the timing. Usually no way, man. It takes years to get to the cash flow that you want to retire or whatever.
What's going on, everyone? Welcome to another episode of The Remote Investor. I'm Michael Albaum, and today I have with me Lee Yoder, who is a multifamily syndicator, but who started out like so many of us do with single-family home investing. So we're going to talk to Lee about what it's like to grow through the ranks and syndicate your own multifamily deals. So let's get into it. Lee Yoder, what's going on, man? Thanks for taking the time to come hang out with me. I really appreciate it.
Yeah, Michael, happy to be here, man. Thanks for having me.
Oh, my pleasure. We are going to talk about some really fun stuff today. But so for everyone who's listening, who might not be familiar with who you are, give us the quick and dirty where you are, who you are, where you come from, and what is it you're doing in real estate today?
Yeah, sure. So I live just north of Cincinnati, Ohio. I've always lived in Ohio, born right here in Ohio. Grew up on a farm, went to a small college, played some football, became a physical therapist. So I had to go to grad school. Now they make you get your doctorate to become a physical therapist. So went to college for 7 years, got my doctorate in physical therapy, came out 2012, I guess, was practicing physical therapist. Got in with the company. I was doing home health physical therapy, and I got in with the company, became their clinical director, started doing, it was like a startup company. And I was like kind of building out a division for them. And so because it was a startup company, like it was a very entrepreneurial feel, and I loved it. I loved that entrepreneurship part of it. And I pretty quickly with that company, I was doing no physical therapy anymore. I was in the office, building this division, managing therapists, doing sales, doing operations, and loved it. Did not miss doing physical therapy at all. So when I decided to leave that company, I'm kind of like, what am I going to do? Because I don't want to do physical therapy anymore. I want to like build something. I really didn't know what that meant. Yeah. But I just knew I wanted to like build something, maybe build something of my own. So I just started reading books, listening to podcasts, talking to people. Of course, I read Rich Dad, Poor Dad at this time, went down there rabbit hole. And that book for me, I mean, it means a lot for a lot of people. And to me, it was just like, there is a different game. There is a different game besides just going back to the W-2 and just going that route. And, for me, the only like second level, third level, whatever of success in my career meant just doing really well at my W-2 and getting a raise and getting a promotion. And like, it seemed like there was just one ladder I could climb. And Rich Dad Poor Dad to me was like, well, there's a whole different ladder that you can climb. And to me, probably it goes a lot higher. And so I'm like, well, I think I want to go do that. I had a buddy at church that was in real estate full time, was talking to him about, how maybe I could get into that. My dad's in construction. I grew up around construction. So that piece definitely spoke to me. I love math. I love spreadsheets. So just the more I learned about real estate, I was like, I think this might be what I want to do. So I went back to doing home health physical therapy. It's a very flexible job. My patients would just come to my phone. I kind of see them whenever I wanted. It's got to work for them, of course, got to work for me. But like I got paid per visit. So if I didn't do any visits one day, but nobody needed seeing that day, then I wasn't getting paid and I could go do real estate all day if I wanted to. So it worked really well. And so that's what I did. So I left that corporate job in 2016, took a really big pay cut, probably 30% pay cut, went back to doing home health physical therapy. 2017, we got a house to flip. Did that, bought that an online auction, sight unseen. Of course, we did see it. We did, kind of break in and see it. But did that flip the next year. Yeah, we let no one was there. So, we let ourselves in. 2018, we kind of flipped a duplex, and 2019, we got a 16 unit, apartment pretty quickly after, got an 8 unit and a 10 unit, kind of flipped all of those for a year. The COVID stimulus boom took off. I sold that whole portfolio, put all the profits in my savings, quit my W-2 as a physical therapist at the end of 2020, went all in on real estate, started syndicating, bringing in more investors, buying bigger apartments in 2021. Been doing that ever since. Started managing our own properties a couple years ago. So today we own and manage almost 900 units.
Dude,
that's the full story.
This is so cool. There's so much to dig into here. So let's go back to that first deal. You said we flipped a house. Who is the we in this scenario?
Yeah, me and my wife. Me and my wife that I am dragging along every step of the way.
Okay, well let's talk about that for a minute. So it sounds like you got bit
Yeah,
by this bug. You saw the vision. You saw that there
yeah.
was this other game being played, this other ladder that was available to you. What was her mentality at that point in time?
My wife and I, we heard this on a podcast somewhere, I think, and somebody suggested, at the beginning of the year, because my wife and I we'll fast at the beginning of the year and do like a kickoff weekend, and we really pray about what we want to do that weekend. One thing that we threw in there that we heard on a podcast is we each pick a book for the other one to read. So that year, I was so excited for her to read Rich Dad Poor Dad. She read it, Michael, and she said, "I'm the poor dad. I want to be the poor dad." I mean, that was her takeaway. I said, no, you got it wrong. Reread it. No, that's the wrong answer. What are you doing? So that's how she felt about it, was like, I'm good with the poor dad. You've got a good job. It pays us enough.
Don't rock the boat.
I'm good. Yep.
So how did you convince her? Because I think this is such a common tale for so many couples. One person gets bit by the bug, the other person less so. So I know you said you were dragging her along. I mean, really, was she not excited about it? Talk to us about what that was like.
Yeah. So fortunately, she loves me terribly. We both do. And so she knew how badly I wanted to do it. And so, we follow Jesus, and, he tells us to serve the other above yourself. And we certainly believe that in marriage. So ultimately, she did want me to follow that dream. And so she wanted to get on board with it. But, kind of the tangible side of it, the logistics of it, the nuts and bolts, I was like, okay, let's start small. I mean, let's do the smallest thing that we could think of. Like, let's just do a single family hit flip. It was in our town. It was, right down the road from where we lived. And I said, what is the worst case scenario? The worst case scenario is we use our HELOC, because we were using our HELOC. We buy it. We put some money into it. We get a mortgage on it, and then we are paying off 2 mortgages. And at that time, my salary could support those 2 mortgages and our lifestyle. So okay. I was able to convince her that is the worst case scenario, and that's not that bad. You're paying off 2 houses. We're happy with the house we lived in. Like, she wasn't really looking for anything else. She just wanted life to stay the way it was. We had young kids at the time. So she's like, Lee, my world is so small. I'm just trying to, raise 2 humans and keep them alive. I don't want to be disrupted from that. And like, for her, the fear was like, you could bring all this crashing down. And, first she's like, I love my life. I'm good with it. I don't need all this more that you're chasing. I'm good with this. But I was kind of able to convince her, well, worst case scenario, we don't get rid of this. It's just now we got a second mortgage. So that's how I got her comfortable with, like, let's just try it. Let's see what happens.
Yeah, no, I love that. That was something that my dad did for me when I first bought my first rental. He was like, look, don't look at the number that you're signing your name to in terms of the mortgage. Look at what your monthly payment is, and how does that impact your life? Because you're going to pay it off over 30 years. So you've got time on your side. Yep. So I love that approach. And I'm curious, like, why did you approach it from the flip? Why not buy a single family home, put a tenant in there, and just do the long-term rental kind of a thing? Did you have construction background? Does your wife have a background in construction? I know you said your father did, but so was he doing the rehab for you?
No, I definitely had a background in it through my dad, and during college, that's what I would do during the summer was construction. Did some roofing, so I was able to do a lot of the work myself. And I think we felt like we were going to put so much work into it and increase the value so much, and we didn't. Man, as much as we wanted to, I already knew I wanted to own rental real estate. Like I understood owning rentals is investing. Like the concept of like, the income is more than the expenses, and they're paying off your mortgage and all. Like, I understood all that, and I knew that's where I wanted to get to, but I didn't want to have renters very bad. Like, I didn't want to manage them. So I think we just felt like, let's try a project and make money off of it and be done with it and see what that looks like. And I think we just felt like a flip is where you're supposed to start. So yeah, I don't know. I think that's as much as we thought about at the time. We didn't know that much.
I love it. That's so many people's story. Like mine too. My purview was this. This is all I knew was like single family rentals, buy and then
Yeah.
have someone rent it. And that's all I knew. Flipping was like, I don't know. That's for rich
Yeah.
people. That's something that I could never do. And it's funny how
Yeah.
our
Yeah.
experience teaches us otherwise, right?
Yep. Yep. Yeah. Good point.
So, okay, tell us how that first flip went. Clearly, I'm guessing it went pretty well. Otherwise, you may have thrown in the towel.
Yeah, yeah. Well, I kept telling people, I was like, I got to prove two things to my wife. One, that real estate makes money, and two, that it's going to improve our lives. Because again, she wasn't like really money hungry. She's like, I like our life. But I was like, but this is going to make our life better. And not just because of the money, but because of like the time, like that time freedom that everybody talks about, financial freedom. So we did the first one. We did not do the second one. I did not meet the second goal. So we did I think we made 30 grand off that flip. And I told you I took a pay cut from the W-2 job. That was about my pay cut. So it was like this perfect picture of, I had this really busy corporate job that we, neither of us felt like that was the life God was calling us to. I came back to doing home health physical therapy. I was bored. I was making enough money, but I added real estate on top of that. And then I was just as busy as I was at that climbing the corporate ladder job. And I made the same amount, but it didn't improve our life. Like I was just as busy, right? I was away from home just as much. I was working evenings. I'd get up in the morning, like super early in the morning before the kids got up and go out there and work. I'd work on the weekends, and not the whole time. It took 9 months to do the flip, but mostly that last few months was like, shoot, we got to get this thing done. Selling season, May, is fast approaching. And so those last few months were just, my wife was like, this is not the dream you sold me on. Yeah, great. We didn't lose money. We made some money. Happy about that. But I'm not into it. Like, we didn't need that money. It was kind of miserable. So some good, some bad out of that first flip.
Okay. No, that's so great. So how were you able to sell her on this second flip? Because your next one was you flipped a duplex, you said, right?
Yep. Yeah. So it took some time. So we sold that one like in May or something. And then by August, I gave her the summer off, I guess is what I said. I gave her the summer off, where I was just doing home physical therapy, and we found a duplex. And that was more like, so again, it was helpful. And this is why God put us together. And we drive each other crazy, but we're ultimately a great match and great business partners because, I was ready for another flip. I mean, this was awesome. This was great. We made money. Yeah, we'll do it better next time. We'll just keep flipping. But like I said, from the very beginning, I knew like flipping wasn't my goal. My goal has always been to own multifamily, but I just thought I had to start with a flip. But then I thought like, well, we probably need to do a few of these. Let's do some more of these. But she's like, nope, that wasn't it. Pump the brakes. And so in doing that, it was like, oh yeah, okay. Yeah, that isn't what I want to do. And that's not the dream I sold you on. So like, all right, what if we do a duplex? What if we do a triplex? So, and she's like, well, that sounds more like what you were telling me about, that like we kind of flip it, but then we have renters. We flip it into like a mortgage and have renters and all that. So let's try it. So when I found a duplex, she was ready again. And then since we did make that money off the flip, I mean, again, my salary was enough for us. So we did have that. So it felt like, okay, we do have a little extra cushion now. We could bring that money to the next one. And so, yeah, just time does heal. And so coming off of being so busy and working all those nights and weekends, like after a couple of months, it was, I hadn't done that for a couple of months. And so it felt better. So she was just ready, like, okay, let's dip our toes in again. Let's try again. Had a nice summer. I know you're going to do another one. Yeah, let's try a duplex. And so I guess that's kind of what got her ready for it to try that next.
I dig it. And then, so did you flip that one and truly sell it, or you've kind of bird it and kept it as you kept it long-term, put tenants in there?
We did basically flip that one as well. Now, but we did have renters in it for a few months. So we kind of got to see that, hey, the renters are in, again, income, more than expenses, also pays for our mortgage. There's some left over. And it was like, okay, but the kind of the lesson there for me, like, or what I took away from that was like, I think, I mean, man, this was 2019, like I said, so you could buy things way cheaper back then. And I think we're making like maybe $200 per unit per month. So we're making $400 a month. That's $4,800 a year. That's not retiring me anytime soon. Because by this time, man, I'm all in on real estate. So I could not wait to do it full time. And so I looked at it like, okay, that's great, but I need more than that. And like, okay, let's say I did 10 of those. Okay. 48 grand a year. Okay. What about 20, 96 grand? Okay. Now I'm talking, but I didn't really want to do 20 duplexes. So that's where I said, okay, let's sell this. I don't want to own a bunch of duplexes. I want to go bigger. Again, I just always knew I wanted to own multifamily. I wanted to go bigger. And so that was kind of why we sold that. So yeah, we sold it in under a year. It truly was a flip, but we did get to see that proof of concept of having renters, having residual income. I mean, since we flipped it, like the work was kind of done. So we truly didn't get calls from our residents. Like there wasn't anything else to do. We had done everything. So it was pretty passive. And so I was like, oh yeah, this is pretty nice. I mean, even my wife by this time was like, this is pretty nice. I get this. Like, yeah, this is more like it. Yeah. Yeah. So it was like, well, let's just do more of that. But I wanted to go bigger because even though it was super easy, we had great renters. We were managing that one ourselves. And we just didn't like that. She didn't like the burden of worrying about something happening to our residents and it being on us. And what if we get it? So that was another reason I knew I wanted to go bigger too, because I didn't have any interest in property management. I said, I can't build like an investment company and a property management company at the same time. That was my thought. Plenty of guys and girls do. But I was like, I just want to buy property and be an asset manager, not a property manager. So that was another reason we wanted to go bigger, because bigger properties, more units makes property management make a little bit more sense price-wise.
Totally. Well, man, I am super excited to keep picking your brain about like the next deal, because people talk about growth, but you went 1 to 16, if I heard you right. It's kind of exponential. But you said something that I want to come back to, and that's you were all in on real estate. You want to do real estate full time. I hear people talk about this and say this all the time. What did that mean for you? Like actually doing real estate full time? What were you doing on a day-to-day basis that required you to be working full time as opposed to do this side hustle and continue to have a W-2 or some kind of other part-time job?
Yeah, I mean, it's so you got to find money, you got to find deals, and then you got to operate them. And for me at the time, I really wasn't raising much money. So we didn't on the single family or the duplex. On the 16 unit, we did, but just one investor. So I really wasn't doing that much before the 16 unit. But I was basically a general contractor back then. I was the GC over the project, okay, who's painting for us? Okay, bring them in. Who's doing that? And then as we get into the 16 unit, I still kept doing that. So I loved being out there at the properties and running the show and deciding what needed to be done. So I loved looking at deals. I mean, my favorite thing, like what I'll do on a Saturday morning, Sunday morning, get up, I can't help it. Like I want to look at properties. I want to underwrite properties. I want to look at properties. So that's probably my favorite thing. So that's something. And then once you get one, that's you.
Yeah. Same boat.
Yeah. So that's my favorite thing. But then once you find one, man, then putting it all together, pulling the financing, raising the capital, who's going to manage it, pulling all that in. And then of course the operating, that's honestly my least favorite part. I like putting it together and then move on to the next one. But I did enjoy it. At the time I was spending a ton of time out at the properties, just kind of managing everything, making sure it went okay. So that's the best way I can answer your question as to like what I would be doing all day, every day or whatever.
I love it. Okay. So you went and put this 16 unit deal together. You got one investor, which I want to talk about because I think you have lived the trajectory of so many people's goals. They want to start with one, then two, then grow and do multifamily and eventually get into syndication because so many of us, we run out of our own money to go do bigger and better deals. So how did you convince this investor that you were worthy of to be a good steward of their money for this deal?
Yeah, well, it was my in-laws. Okay. So you start with people who love you and want to support you and maybe are willing to take a risk on you. My other first investor was one of my best friends from church. And he went in on it with me. So we went basically 50-50 in that one. And then my other first investor was my parents. So it's your close circle. But I'll tell you, I don't want that to get people down my cliff. They're like, oh, well, great. My in-laws and my parents and my best friend at church can't invest with me. So I guess I can't because I live around a bunch of people that don't have $100,000 to throw at a deal. The other thing, early investors for me, and a bit of my story too, Michael, of how I got into that 16 unit was join the local RIA. So our Real Estate Investors Association in Cincinnati is pretty strong. So maybe it's not that, but there's a ton of good real estate groups, right? And those are such warm leads. Those are people that have already raised their hand and said they're interested in real estate. A lot of them will want to partner with somebody, and a lot of them are older and have money and not as much hustle as you. So that's what I end up finding. And even I found that in my in-laws and my parents and stuff, like, okay, yeah, we've got some extra money. I mean, neither of them made a lot of money, but they're both like super frugal, paid off their houses, stuff like that. Like they had cash, and they were like, I mean, they just saw what we did with the duplex. They saw what we did with the flip, and they knew our integrity because they knew us, but also they saw how hard we worked. They saw that, like, okay, you're 2 for 2 so far. You know, you seem to be figuring it out, or at least you hustle enough to work it out when you don't figure it out. And you know, I showed them the numbers. I did, you know, put together something like, here's my underwriting. And through the RIA, Michael, I was learning. They had an apartment focus group at the RIA. And so I was going to that every month. And there was a guy leading that group, and he hadn't done a lot. I think he had bought a 25 unit and a 40 unit. But I mean, to me, that was, you know, a ton. And he had gone to a boot camp, you know, one of these boot camps where they teach you how to do syndication. So he held my hand through that 16 unit. I would not have been able to do it without him. So that was huge. I gave him a piece of that deal, and he just walked me through each part of it. But yeah, that's so I had that underwriting that he was kind of teaching me to do, and it was very basic underwriting, but kind of put together a simple PowerPoint presentation. And obviously, it's just talking to my father-in-law about it, because one answer to your question of like, just how do you start raising capital? And everybody says this, but it's because it's true, is you just start talking about it all the time. Because the more you talk about it, people are going to see that you're passionate about it. And they're, you know, some people are going to want to be a part of that. Some people are going to buy into that. And that's basically what happened with my in-laws. I was just telling my father-in-law about it, and like, yeah, so you know, here's what we're doing. And, you know, here's the next project. I mean, he helped us a little bit on the duplex and the flip, and was out there and saw it, and, you know, got to be a little bit of a part of it. And then I'm showing him, well, here's the next one. Here's what we're doing. And I said, yeah, so on this one, we're going to try to raise 100,000. And he was like, I think we'll just do that. We'll come in on it with you. And I mean, blew me away, blew my wife away. My wife couldn't believe it. She's like, there's no way. They would never do that. They're too conservative. They would never do that with us. But they did. So yeah, just from talking about it and them seeing what we had done so far.
I love it. I love it. So then what was the strategy behind this one? Did you have to do a bunch of value add, like physical renovations to the 16 unit in order to be able to sell it down the road? Walk us through, what did you pay for it? How much did you put into it? And what was the strategy and thought process behind it?
Yeah, I'll tell you, Michael, I mean, the starting thesis of it was, you know, we found this on LoopNet. I'm sure your listeners have heard of that. Yeah.
Yes.
Yeah, man. Because you know what you hear? I don't know if you've heard of this. LoopNet is where deals go to die. Have you heard that?
Yes. And where we go to pick them up.
That's exactly right. That was exactly my thought process. I said, if that's where deals go die, I think that's probably where I'm going to find my first deal, because it just didn't make sense to me that a broker would pick me over a legit buyer, you know? So I'm like, that's where I'm going. And honestly, the flip was like that. The duplex was like that. I just felt like, again, and I don't think this is true, but my mindset was, I just have to buy crap. I have to buy crap and use my sweat equity and make it decent. You know, and so that's kind of what we did. So this was an old school building that had been turned into a nursing home, and then it had been turned into an apartment. So it already was an apartment, still looked like a school, still had a cafeteria. It was a mess. The guys were out-of-state owners. They were having a resident accept cash from all the residents. It had 3 or 4 vacancies out of the 16. Had a lot of issues. The hallway was dark and dingy. We paid $350,000 for that property. And then we got $100,000 credit for the roof, because almost the entire roof needed replaced, a flat roof. So we bought it pretty well, but it was rough.
Okay. I love it.
This was 2019. So different time than today.
Very different time. So I was buying stuff in Cincinnati and Northern Kentucky at a smaller unit count, but around similar price point per unit. And so when I tell people that, they're like, that's impossible. I'm like, no, but I just bought the stuff that nobody else wanted. Yeah, exactly. So how much money did you put into it? when it was all said and done?
Yeah, I think we put in. Okay, I think we put in about 40 or 45,000 because the 100 paid for the roof, and then we probably put 50,000 into a handful of units and the hallways. A lot of landscaping, but I did a lot of the work myself. But yeah, mostly just the hallway because it had these big like school hallways. And so we redid the flooring, painted the walls, redid the lighting, and then renovated probably by the time we sold probably 6 or 7 of the 16 units. And then I did a bunch of landscaping, but did that myself. We did a little bit to the parking lot. It was a small parking lot. I think so. We probably put 50 grand. I think we had like 70,000 down and then put 50 into it.
Okay. All right. That's a lot less than I was expecting you to say for that size of a property. So once you did that, and I'm sure you turned over some of the tenant base and got new tenants in. So do you remember what the rents were at the time when you went to sell the property?
Man, I know when we got it, they were I think some even in the 4s, but most of the 500s. And I think we were just getting them up to like 700, plus, and they were I think all 1 beds. Yeah, I think that's right. I think they were all 1 bedrooms. So smaller, and they were small 1 beds. So I think we were up to like 700 with maybe a $25 $25 utility fee was what we got them up to. So probably from like 550 range. And that was slow. So the way I've always done it, Michael's like, if somebody's paying 500, like their first rent bump might be 100, might probably 75 is often where we come in at. So it's pretty significant, but we're not taking them up to 700 or 750 if we feel like that's where market is. But if somebody moves out or there's a vacant unit, they're obviously coming in right at market rent. So by the time we sold, we probably had some people in the 700s. We probably still had some people in the 600s. But that was from everybody being in the maybe even 4s, but 5s and 6s.
Yep. No, that makes sense. And that's something that I do too. And that's something I always encourage people I chat with to do is like, hey, if you got good tenants, don't kick them out just because you're trying to go get market rent. Like work with them, figure out what's going to do, because 1 month of vacancy could kill the entire rent increase that you're getting for a year from someone. So like, just be smart about it and be a human being about it.
For sure. Yeah, I agree with that. Yeah, it works for us and it works for the residents too. It's a win-win for everybody to do it that way, I think.
Yeah, that's great. And then, so I know you sold it as a package as part of a portfolio, but did that building have a price that on title, like on the HUD or the CD, what did you end up selling that property for when it was all said and done?
We sold the whole portfolio, but we did sell them separately. They were to separate buyers. Okay. I just kind of sold them all about at the same time. But yeah, so that one sold for $615 was the sale price on that one.
Dude, I freaking love it. What a cool success story. Yeah. You doubled it in the span of a few years.
A year. It was 1 year. Just over a year. Yeah, man. The COVID stimulus boom, man. I wish I would have bought more. When they start printing money, multifamily and all assets do very well when they start handing out money. So, wish I would have done more back then. I know.
It's the classic line. So walk us through now, Lee. You've got 900 units. You're doing multifamily. You're syndicating. Like, is this the promised land that you told your wife about? Is she on board now?
Well, it's funny you ask that. So syndication. So the problem with syndication is, at least the way we do it. So there's different ways of doing it. The way we do it though, Michael, we give our investors a preferred return, which, I kind of explain that, but just like we generally do an 8% preferred return, which means our investors have to make an 8% return on their money before me and my team get anything as far as cash flow goes. Well, really, as far as any profit goes. So what that really means in practice, and today, especially when interest rates are high and prices are still high and rent's kind of stagnant and expenses are going up, so I can complain about all these things. But basically, that just means the investors get all the cash flow. And that's really for the first 2 to 3 years. So no, we're still not living the dream of a bunch of cash flow. Now, we've sold quite a bit. So we've, when we sell, we do make a lot because, we basically try to give our investors a lot of the cash flow, a lot of the assurity, but then we do keep a lot of equity. So in some of our deals, we own 50%, and that could be with a partner or two that we bring in on that deal. But we have typically done like an 8% preferred return. And then above that, it might be 50-50 and sometimes 60-40. But we do have a decent amount of the upside. And these are smaller deals. So if I did bigger deals, it's going to be 70-30, 80-20 like everybody else. But so we've done well on some sales. We do take an acquisition fee. The acquisition fee is 2% of the purchase price. Again, if we did even bigger deals, it would probably be 1.5 for 1. But that kind of pays my salary. So we're making good money. We have a lot of money in the savings account. But what my wife's really looking for is monthly cash flow. And to be honest with you, we're really still not there quite yet, because the properties that we would be there on, we sold. So we made a lot and got to put it in our savings, and it like kind of snowballed. But so we have a lot in our savings, but it goes down most months is the problem. And then we buy something and we take an acquisition fee and it bumps up, or we sell something and it bumps up. So the savings account has gone up every year, for the past 6 or 7 years that we've been doing this or whatever. But yeah, we still don't really get much cash flow. Now, we're getting closer. The real key there, Michael, to me, is refinancing. If you can own something for a few years, 3 to 5 years, do your repositioning, refinance, and get your, this is the way we do it. If we get our investors' money back to them, the preferred return goes away. Okay, so now it's just a 50-50 split of the cash flow, or a 60-40 split of the cash flow, or 70-30, however it's set up. Because I tell them, like, hey, that preferred return, that's kind of like us paying interest on the money that you're loaning to us to buy the property. Once we give you that money back, we don't owe you that interest anymore. You got your money back. You can go get another deal. That's when we would get the cash flow. And like I said, just for whatever reason, we've been kind of opportunistic. Instead of doing that refinance, we've sold up to this point. So we did well on those sales, and we made it bunch of money and put it in our savings, and it's helped us move forward, and it's allowed us to invest more in our deals and things like that. But we just haven't got to that point yet where we've refinanced some deals and we're getting some big cash flow. And then, as you know, like just most of the new deals we're buying, like I think they're good deals, but it's hard enough to cash flow 8%, let alone try to get to 10%, where the investors would get 9 and we'd get 1 if we were split 50-50 above the 8%. Right. So yeah, to be honest with you, man, that's, I do think I'm gaining a lot of equity in these deals. I do think it's working and we are building incredible wealth. But outside of selling and COVID really helping me, like kind of supercharge that, Michael, I would not have the cash flow to not have a job. And my wife doesn't have a job. We homeschool our kids. She works with me. That's why I say we a lot. And a lot of it's just her listening to me. But that's a job. That's a big job. Somebody's got to do it. And, but we work together. So we don't have any W-2 income. We had to go get our own insurance. So, we really do rely on the properties. But most months we're not buying and selling. And so most months our savings does go down. So I want to be real about that. I love syndicating. I love buying multifamily. I think there's a bunch of different ways to do it. The way we do it's just one. I do think it's real, Michael. So I do want to say that. But yeah, I want to be real with people. I mean, we're several years into this. We have made quite a bit of money on it. We do, own a big chunk of, we're the biggest owners in those 900 units, even though we're not putting up a bunch of money. We get to own a bunch of the equity because we're doing the deal and everybody else puts in the money. So again, it's awesome, but like, no, it's not like quit your job in 3 years. It's not even quit your job in 5 years, honestly, at least from what we've seen. Again, I guess I should say, like, we have sold some, we can live off the savings and quit our job, but off of the cash flow, no, it's not paying us. And that's what my wife wants to see. She keeps saying, I don't care about that. I want to see that. And so we're not there yet. So long answer, man. But yeah, that's where we're at.
I love it, Lee. And I can't tell you how much I appreciate the honesty and transparency, because I've spoken to so many syndicators and they're like, it's the best, is retire and go buy a Lamborghini. And it's like, maybe. So I love the fact that we're talking about this, because I think it's so often the trajectory and the goal of so many investors of like, that's where I want to get to. And I think hearing you say this is so important to really understand. It's like, okay, that's totally fine if that's the goal, but you need to understand what the reality is, the day-to-day reality, and the long-term, the 3 to 5 to 10 year plan. Like, I have no doubt in 10 years, you're going to be a multi mega gazillionaire. But on the road to get there, you need to figure out a way to support you and your family. So I love that
Yes.
we're talking about this.
Yeah, 100%, man. Yeah, I've heard somebody say, and this was a little bit what led me to eventually bring property management house, because that has helped with the cash flow, just because that property management fee, it allows us to hire some people and build a business. So I'm not just relying on acquisition fee. So there is some cash flow in that, because somebody said, they're like, man, if you want to get into syndication, if you want to buy multifamily and like build this multifamily or just even like rental portfolio and live off of it in a short amount of time, you either have to come into it with a ton of money, right? Like I got millions of, these guys that sell a company or something, like, sure, yeah, go throw millions of dollars at real estate. It'll give you a good return. And then you can not work, right? That's not most of us. It certainly wasn't me. Or you have outside income. So a lot of people that do what I do, that burn the boats and go in, their wife works full time and has a good salary and has benefits. So that's a way to do it. We didn't do that. We wanted to homeschool and make it harder on ourselves, I guess. And so we didn't do that way. Or like what you just said, Michael, have ancillary income, like start a property management company, or, maybe you have another business that you're doing and that gives you the cash flow. Cause man, yeah, if you're buying real estate, I think it was one other podcast that would say, like, this isn't a get rich quick scheme. It's a get incredibly wealthy over a long period of time. And so that's what I want to say to you, Michael. Like, is it what we all thought it was? Yeah, I think you're right, Michael. I don't think I'm going to be a mega gazillionaire, but somewhere close. Yeah, I think it's all working, but man, no, it's not. It's not quick. It is not quick. So yeah, if you think you're going to quit, it's not going to be just by buying multifamilies. Not today. Not with interest rates where they are, prices where they are. And probably there's been very few times where you could come at it and quit in 3 years or something off of the cash flow, right? These right. moments in time, like 2019, the COVID stimulus in 2020, 21, like these moments in time where you can, like, like I did, double a couple and just get lucky on the timing. Usually no way, man. It takes years to get to the cash flow that you want to retire or whatever.
Yeah. Yeah. No, I think that's so great. Lee, I want to pivot here just for a minute while I still got you. You mentioned that you started syndicating really in a big way in 2020, 2021, and you're sitting here today. We're talking about multifamily syndications and you still own them, which means you probably did something right as compared to a lot of the other syndicators who got started at that point in time and had to give those properties back to the bank. So what did you do differently? What do you think you got right when you set up your syndications? And looking in the rearview mirror, what did you wish you had done differently at that same point in time?
Yeah, great questions, man. Part of it was just being a little bit lucky. I live in the Midwest and I just wanted to, I guess I made one smart decision that I wanted to invest close to home to start out with. So I think that was probably a wise decision, but it just happens that the place I invest in the Midwest. And I just bring that up because the Midwest is less of a boom bust market. So the Midwest is one of those markets that's doing pretty well right now relative to some of the other boom bust markets where they were all dancing in 2021 and 2022, right? Because they were going like this. And, if you're listening, like I'm pointing a line going straight up, but then they're coming down a lot harder. And we're not seeing that in the Midwest. Things have been much tougher in the past couple of years. I see these things that say like Cincinnati is seeing 6% rent growth. And I'm like, I don't see that. I don't know where you're getting that, but we've been flat for a couple of years. So, but we're not, we don't have the same inventory coming online either, right? So we're not seeing as much pressure from that in those boom bust markets. All the developers rush in, right? So part of it is just being lucky to be in the Midwest where I live. We never have done the bridge debt stuff. So I did have some wise counsel on that, Michael, where, I was talking to a mortgage broker that I've become friends with, and he's like, Lee, they're pretty sharky loans. That's how he explained it to me. And I'm like, that doesn't sound good. And he's like, no, they're not. Like, they serve a purpose. But so, man, I was just steered away from that. And at the time when interest rates were good, it just didn't make sense to me to like not lock them in, for a good 5 years. Like, it was like, man, we still had some flexibility to get out in 3 years, but we could lock them for 5. Why wouldn't we do that when they were low?
For a quarter point difference in rate. It's like,
I know. Yeah. It didn't. So some luck there for sure. Some good counsel, buying in the Midwest, locking in our debt. Those were the things that we did well. I also, Michael, I guess I was fortunate to start when I did, where like we were buying for 30 a door. Right. And then by 2021, when I'm syndicating, now we're buying for 60, and I can't believe I'm buying for 60 a door. So I think that helped for me to be like, geez, what are these people, and even 60 were at the time. Again, now I say, like, I wish I would have bought more. But it helps just to stay grounded. And man, I've always been obsessed with cash flow. So again, I'm not getting much of it, but I do want it for my investors, because to me, Michael, cash flow has always meant margin. So if you've got a deal that you think is only going to return 3% to your investors in year one, that might be okay. Like, that's fine if that's all it is. But when I see that 3%, what that tells me is that's all the margin you have. So if you're 3% off on your cash flow, and by math, I mean 100% off of that 3%, right? Like, if the 3% is, if you come down from 3% to zero, you're barely making your debt payments. If you're a little bit less than that, you're not even making all your payments, right? Whereas for me, yeah, I like seeing 7-8%, but it also helps that, like, man, we got to come way down off of that to not meet it, right? If we raise $1 million and I think we're going to return 8%, that's $80,000 per year. So I got to be $80,000 off before we're only making our payments, right? And I got to be $90,000 off before we're $10,000 in the hole. If we're only expecting a 3% return in year one, I only got to be $30,000 off to not be making our payments. So that's what cash flow has always meant to me. So that was something that I, like, the deals I was looking at, that's what I was going for. And I think those deals have held up better, because cash flow doesn't go away as quick as a future value, right? As quickly as something like, hey, yeah, we're not cash flowing that well, but we're buying for 10 million. Somebody else is going to buy it for 15. That can go away real quick, right? But your cash flow, it doesn't go away as quick. Yeah, expenses can go up faster than you expect. Rent can stagnate. Again, so your 8% might turn into 6, but there's some margin there. So that's probably what I did right. Definitely one thing I did not do right, Michael, and I feel like I'm still learning this today. I don't know how many times I have to learn this lesson, but it's just, and it is hard. It's easier said than done, but like, I wish I would have raised more capital, just had more capital reserves on projects. And what I've really found, Michael, was like, I'm doing a great job of raising enough capital to operate the property and do our repositioning plan for 3 years. And after 3 years, if we're not ready to refinance or sell, those next couple of years are a lot tougher. Because on one project right now that we actually are selling, we're almost to our 4th year. And I'll tell you, this last year has been really tough because we've done a great job. The property's worth a lot more. It's why we're selling it. But if we were to continue operating it, we really don't have enough in our reserves and our CapEx fund anymore to fund all of the unit renovations that we have to do. When people move out, they've lived in the unit for 10 years, it needs a $10,000, $12,000 renovation. We're now funding that as an expense. And so you do not cash flow when you do that. At least the way I've set them up, because we had this CapEx fund and we're like, we're going to do 65 unit renovations out of the 96. And then we're going to sell after 5 years. Well, we've done like 55. They've been more expensive. And, we bought it before the inflation started going nuts. So I guess I can, use that excuse. But we've done 55, but we really don't have more CapEx funds to do another 10 or 20 or whatever. And so we've done more than we thought we'd do. It costs more. And so now we've gotten to a spot where, like, shoot, we need to refinance or sell because we don't have the CapEx fund to fund the big projects that suck out all your cash flow that you want to send to your investors. So we're stalling distributions on that project. And so that's teaching me, man, you better have a full 5 years worth of CapEx projects if you plan on funding it for 5 years and cash flowing. So that's one thing. That was kind of a long answer, but raise more CapEx and plan for that 5-year hold.
Yeah, no, that's a great takeaway, Lee. And it's just like treating your cash flow like your margin, like your CapEx, you need to have a margin there too, like above and beyond, because things happen tomorrow, let alone 3-5 years down the road that no one could have predicted. So just having some extra dry powder is great to know.
That's right.
Man, Lee, this was awesome, man. Thank you so much for, again, kind of peeling back the layers and opening up to us about what it's truly like, a day in the life in the syndication world. If people want to reach out to you, learn more about you, invest with you, where's the best place for them to get in touch?
Yeah, you can. We've got a great website. It's threefold, rei.com. That's the number 3 spelled out, THRE, and then FOLD, and then REI is in realestateinvesting.com. We've got some free stuff there and a bunch of content. You can reach out to me through there. And then I'm really just active on LinkedIn. That's my social media of choice. So if you look up Lee Yoder on LinkedIn, you'll find me.
Awesome. Well, hey, thanks again, Lee. Truly a pleasure, man. And we will definitely be in touch. Take care of yourself.
Yeah, thank you, Michael.
All right, everyone, that was our episode with Lee. A big thank you to him for coming on and just being super vulnerable and real with us. I think so often we hear about all of the guts and glory and all of the wins when it comes to real estate investing and specifically syndication. It's not always what it might be cracked out to be. Cracked out? Cracked up? I don't know what the saying is. As always, we look forward to seeing you on the next one, and happy investing.